If you think the IRS isn't watching you, you're wrong. In 2026, the IRS has a brand new AI-powered audit system, and it's not just targeting billionaires. It's coming for business owners, side hustlers, and anyone who stands out from the crowd. If you make just one of these 8 mistakes, you could be waving a giant red flag that gets you audited this year. Let's make sure that doesn't happen to you, because it's not what you make, it's what you keep. Let's be real. Most business owners are just trying to do the right thing. You file your taxes, you keep your receipts, and you hope for the best. But the IRS isn't playing by the old rules anymore. With $80 billion in new funding, they've built an AI system that doesn't care about intent, it cares about patterns. If your numbers look different from everyone else in your lane, you're a target. And here's the kicker. The IRS's new DIF score system doesn't just look at your tax return. It cross-references your lifestyle, your industry, your bank records, even your social media. The good news? If you know what the red flags are, you can avoid them and keep more of what you earn. Red flag number 1, your lifestyle doesn't match your reported income. The IRS now cross-references your tax return with property records, car registrations, even your Instagram. If you report $70,000 in income, but you're paying a $2,500 mortgage, driving a luxury SUV, and posting vacation pics from Maui, the math doesn't add up. The AI flags you. The IRS uses cost of living indices for your zip code, and if your reported income can't cover your basic expenses, you're flagged for lifestyle audit. They'll look at your mortgage interest deduction, car registrations, and even credit card data. I had a client, let's call her Jessica, who reported modest income but was living large. The IRS sent a letter asking for proof of how she paid her bills. She had to dig up years of bank statements and explain every deposit. It was a nightmare, and it could have been avoided with better documentation and more realistic reporting. Red flag number 2, home office deduction abuse. Everyone wants to write off their home office, but the IRS is getting aggressive. They're cross-referencing your deduction with property tax records and Zillow data. If you claim 1,200 square feet as a home office, but your house is only 1,800 square feet, that's a problem. And if you have multiple businesses claiming the same space, you're asking for an audit. The IRS expects your home office to be regular and exclusive use. They'll check your property records, and if you claim more than 20 to 30% of your home as an office, you're outside the norm. If you claim a home office for multiple businesses, you need to show separate exclusive spaces. One client, Brian, claimed his entire finished basement as a home office for 2 different LLCs. The IRS flagged it, audited both returns, and disallowed the deduction for one business. He ended up paying back taxes, penalties, and interest, plus the cost of a tax attorney to fight it. Red flag number 3, deductions that don't match your industry. The IRS has a profile for every profession. If you're a graphic designer, they expect to see hardware, software, and creative assets. If you're a plumber, it's machinery, fuel, parts. If your write-offs fall outside the industry average, you stand out. The IRS uses NAICS codes to compare your deductions to industry norms. If your expenses are more than 2 standard deviations from the average, you're flagged for review. They'll look for unusual deductions, like a plumber writing off $20,000 in consulting fees or a consultant deducting $15,000 in tools. A client in e-commerce tried to deduct $30,000 in consulting fees with no documentation. The IRS flagged it, audited the return, and disallowed the deduction. Always make sure your expenses make sense for your business and keep receipts for everything. Red flag number 4, claiming 100% business use of a vehicle. The IRS knows that almost nobody uses their car exclusively for business. If you have one car and claim it's 100% business, they'll ask, do you walk to the grocery store? Do you never drive your kids anywhere? If you can't produce a mileage log, they'll disallow the deduction and hit you with penalties. The IRS expects most business owners to use their vehicle for both business and personal. If you claim 100% business use, you need a contemporaneous mileage log created at the time of each trip, not reconstructed later. Apps like MileIQ or QuickBooks can help, but you need to show business purpose for every mile. A client, Mike, claimed 100% business use for his only car. The IRS asked for a mileage log. He tried to recreate it from memory, but the IRS disallowed the deduction and added a 20% accuracy-related penalty. He ended up paying thousands more than if he'd just claimed 70% business use with proper records. Red flag number 5, hobby losses. Losing money 1 year in business, losing money 3, 4, or 5 years in a row? The IRS calls that a hobby. If they decide your business is really a hobby, they'll disallow your deductions, go back 3 years, and add penalties and interest. Section 183 of the tax code, the hobby loss rule, lets the IRS reclassify your business as a hobby if you don't show a profit motive. They use a 9-factor test, separate accounts, time spent, expertise, history of income, and more. If you fail the test, you lose all your deductions. A client, Linda, ran a horse breeding business that lost money for 6 years. The IRS audited her, applied the hobby loss rule and disallowed $120,000 in deductions. She had to pay back taxes, penalties, and interest, plus legal fees. Red flag number 6, meals and entertainment abuse. The rule is simple. Meals are 50% deductible if they're ordinary, necessary, and directly related to your business. If you're making $60,000 a year and deducting $12,000 of meals, that's a red flag. The IRS will want to see who you ate with, what you discussed, and why it was business related. The IRS expects meals to be ordinary and necessary. If your meals deduction is more than 10 to 15% of your gross income, you're outside the norm. You need to keep receipts, write the names of business purpose on the back, and be able to show a calendar of meetings. A client, Sam, deducted $18,000 in meals from his consulting business. The IRS audited him, asked for receipts, and found that half the meals were with family or friends. They disallowed the deduction and added a 20% penalty for negligence. Red flag number 7, short-term rental loophole abuse. The IRS knows about the Airbnb loophole that lets W-2 earners use real estate losses to offset income, but you have to materially participate. If you work 60 hours a week as a surgeon and claim you spent 500 hours managing one Airbnb, the math doesn't work. The IRS will ask for logs, messages with your cleaning crew, and proof of your involvement. To qualify for non-passive loss treatment, you must meet one of these 3 tests: spend more than 500 hours on the property, do substantially all the work, or spend more than 100 hours and more than anyone else. The IRS will look for logs, emails, and even text messages to prove your hours. A client, Rachel, claimed $40,000 in losses from her short-term rental. The IRS audited her, asked for proof of hours, and found she only spent 80 hours managing the property. They reclassified the loss as passive, disallowed the deduction, and added penalties. Red flag number 8, vacation masquerade. Going to Hawaii for a 2-hour conference and writing off the whole 7-day trip? The IRS is onto this trick. They look at the ratio of business days to personal days. If you can't prove the majority of your trip was business, your airfare and hotel are disallowed. For domestic travel, the trip must be primarily for business. For international, the rules are stricter. If more than 25% of your days are personal, you lose the deduction. You need to keep itineraries, meeting agendas, and emails. If you're mixing business and pleasure, only deduct the business portion. A client, Tom, went to a conference in Miami, stayed for the week, and tried to deduct the whole trip. The IRS audited him, found that only 2 days were business, and disallowed the airfare and hotel. He had to pay back taxes and penalties. Here's where business owners get burned: trusting that their CPA signature is a shield. It's not reviewing their return before signing, throwing away records too soon, and not understanding the difference between tax preparation and tax strategy. The IRS can audit you for up to 6 years if you underreport income by 25% or more, and forever if there's fraud, even if it's your preparer's fraud. Keep digital copies of all returns as supporting documents for at least 7 years and longer if you've had a complex year. A client, Mark, trusted his CPA to handle everything. Years later, the IRS audited a return from a decade ago, found a fraudulent deduction, and opened up every year since. Mark had to pay back taxes, penalties, and interest, plus legal fees. So what should you do? Choose your accountant wisely. Look for integrity, transparency, and a track record of ethical behavior. Review everything before you sign. If something doesn't make sense, ask. Keep your records longer than you think you need to. Cloud storage is cheap insurance. Stay proactive, not reactive, and schedule regular check-ins with your CPA. Understand your industry's risk profile. If you're in a cash-heavy business, your documentation needs to be airtight. Don't be afraid to get a second opinion. A fresh set of eyes can catch mistakes before they become problems. Use cloud-based accounting software to keep contemporaneous records. Use a mileage app for vehicle deductions. Scan and store receipts, contracts, and statements. If you're ever audited, you want to be able to hand the IRS a binder with every document. Getting an audit notice is terrifying. It's not just about the money, it's about the stress, the uncertainty, and the feeling that you're being targeted. But you're not powerless. By understanding the rules, by being proactive, by building a team you can trust, you can protect yourself and your business. But here's what you still don't know. The IRS can audit your business for a tax return you filed 25 years ago, even if you did everything right. There's a loophole almost nobody talks about, and you could be exposed even if the mistake wasn't yours. If you want to know how to protect yourself from the forever audit, watch the next video, The IRS Can Audit You Forever. I'll break down the loophole, the risk, and the steps you need to take to keep your business safe, because it's not what you make, it's what you keep. So keep more.